Lovely. Am I good to start? Everyone can hear me okay? Awesome. So good morning, everyone. My name is Jessica, and I am a mortgage broker with DLC Harmony Mortgage Group, like Kareen said. I have the pleasure of presenting this morning on all private mortgages, all things private mortgages. Many people are aware of traditional forms of mortgages, but of course, the criteria for getting a standard lender mortgage are extremely specific, and not everyone fits the mold. To qualify for a standard lender mortgage, you must be in good financial health and meet the requirements for income, debt, and credit score. So what if you can't do that? Then a private mortgage would be an alternative that could help a borrower achieve their homeownership goals. So what is a private mortgage? Private mortgage is a loan offered by an individual or institution to prospective homebuyers or borrowers who are unable to secure a traditional loan from a financial institution like a bank. Why would you consider a private mortgage? Well, there's many reasons to consider a private mortgage. One, you have poor credit history and traditional lenders won't approve you for a mortgage or won't approve you for enough funds to buy property in your area. Two, you need the money extremely quickly and don't have time to go through a traditional lender's approval process. Three, the property you want to purchase is unconventional, so a traditional lender will not finance it. This can include fixer-uppers, commercial properties, vacant land, rural property homes, or even manufactured or mobile homes where you do not own the land. Four, you need a short-term loan until you're in a better position to secure funding from a traditional financer. Five, you are unable to confirm your income to meet the requirements for a traditional mortgage. Six, you've not completed your 2 most recent tax year filings. Seven, you are a newcomer to Canada who cannot meet requirements of the newcomer programs that are available. Foreign income, foreign credit checks, lack of liquid assets, and a short Canadian employment history may make it difficult to be approved with a traditional lender. Or 8, you are self-employed with irregular income that can't be verified. So timelines. Private loans are typically extremely short-term with typical term lengths of 6 months to 3 years. It is thought that after making on-time payments over this term, the borrower will be in a better position to apply for a mortgage from a more traditional lender. When applying, funds can sometimes be accessed in as little as 7 to 10 business days. Personally, I've seen it done in under 5. If there is a will, there is a way. Interest rates. As everyone is aware, interest rates offered by private lenders tend to be significantly higher than those offered by traditional lenders. We are seeing a little overlap since rates are pretty high right now, but it still can be anywhere from 9 to 15%. The interest rates are technically higher because the payments you make on this loan are interest only. With an interest-only mortgage, none of your payment is going towards the principal, so your total amount owed does not get smaller over time as it would with a typical mortgage. How do you get a private mortgage? Private mortgages are offered by individuals, companies, and mortgage investment corporations, otherwise known as MICs. An experienced mortgage broker can definitely help match a client with the best possible private mortgage options. Qualifying for a private mortgage is generally faster than qualifying for a standard lender, and the requirements are minimal. You will need to show proof of income, so you must be able to show that you have necessary income to make the mortgage payments. This can be tricky if you're self-employed, and the broker may ask to see 6 to 12 months of business bank statements in this case. If purchasing a home, you may be required to have more down payment. Typically, down payment when buying an owner-occupied residence is anywhere from 5 to 20% or more. With private mortgages, they are allowed to ask for whatever they want. So they may require anywhere from 20 to 50%, depending on the rest of the requirements that have been met. The home that is being purchased or refinanced must also have excellent marketability. This is in case the home goes into foreclosure. The lender wants to make sure they'd be able to sell the home and recoup any losses on the financed funds. So are there fees? Of course there are fees. Normally the fee is 1 to 2% for the lender, and then there's an added broker fee of 1%. These fees can go up higher though. Technically private lenders are able to ask for whatever they want. So the lender can normally take this amount off the top of the loan unless the borrower wants to pay separately and doesn't want to qualify for any more than they actually need, which can definitely be an option. So pros and cons. Pros, you've got a faster pre-approval process that can sometimes close as little as 7 days or less. 2, you're suitable for people with poor or little credit history. 3, open to people who do not have a traditional source of income or carry large debt loads. Some cons, of course, there's going to be more cons than pros in this situation, but if you need it, that's why it's there. So con, there are higher interest rates, additional fees for setup and commission, interest-only payments that do not let you pay down any principal owing during the term. Private lenders are not required to be licensed. You cannot be sure of their education or knowledge, and it is important to direct any clients to speak to a licensed mortgage broker to help match them with a good option. And the last one would be harsh implications if you default on the payment. Private lenders have no problem foreclosing on a home extremely quick, serving paperwork with missed payments. And this is normally about 4 times faster than a bank would, which is kind of scary. So are there alternatives to private mortgages? Yes, they are. You could get a cosigner. A friend or family member can co-sign a mortgage and add the strength of their financial profile, while also assuming responsibility for payments if the borrower falls behind. There's the option to rent to own. This is not an option that would be anywhere near my first choice. That's my honest opinion, but it's still definitely an option. These types of programs are structured as a long lease with an option to buy the property at the end of the specified term. The idea is that you can move into the home immediately, but you have a longer time to save up and get into a better financial position to apply for mortgage at the end of the lease. 3 is a vendor take-back mortgage. This is the most popular form of seller financing. This is where the seller becomes the financer and holds the loan for part of the sale price. This is an extremely tricky option. It requires a meticulous legal documentation. And a lender that's willing to take it on, it can be hard to find. The interest rate will also be higher than traditional mortgages because the seller, aka the financer, is able to set the interest rate where they want it. And last but not least, you could wait until you qualify. This is a perfectly acceptable option. Sometimes it is best to just pause and wait. Take this time to get your financial health in order, work on paying down your debts, build your credit score, or save up more down payment. So as all of you lovely people know, and Bonnie has learned, this is my contact information. If you have any information or you'd like to chat, or you have someone that you think may be a qualified candidate for a private mortgage, send them their information. And with that, does anybody have any questions?